Hey, welcome back. In today's episode, I want to run through this article, which I think is very pivotal that you investors need to be concerned about. Now, it talks about DTCC. This is like the US's clearinghouse. Now, not many, perhaps, people are familiar what DTCC or even the concept of clearinghouse. What is a clearinghouse? But these are important institutions that actually provide the counterparty trading of those financial instruments in traditional finance at a global level. Things like clearing commodities trading, clearing securities tradings, even stocks tradings. These are like the market infrastructure layers, if you'd like, that takes care of those settlements of those securities in terms of trading and all the rest of it. Now, as you can see here, DTCC's master plan, it titles Tokenizing Quadrillions, not trillions, quadrillions worth of global assets on the blockchain, albeit under centralized control. So this move of DTCC to move 3.7 quadrillion annually and just painted it a system to bring all assets on chain, this is quite interesting. Whilst, as I said before, keeping that centralized control on the blockchain. As it says here, DTCC stands for Depository Trust and Clearing Corporation. Now this is, as I said, is a critical institution, is a critical backbone of any global financial industry that recently published this patent. It describes DTCC's approach to moving global financial assets onto the blockchain networks. However, unlike purely decentralized solutions, DTCC's approach maintains centralized control. Now, this is one of the differentiating aspects of what DTCC is trying to do versus what we all know about decentralized blockchain. So you might have heard about Bitcoin, you've got Ethereum, you've got Solana, you've got XRP. So these are all decentralized networks or examples of different flavors of decentralized networks. And they're not run by a centralized control institution like DTCC. Now, this is an important difference that you need to appreciate. The patent shows that DTCC wants to dominate the tokenized finance globally. Now, this is clearly the ultimate driver of this move of DTCC. So the actual content of the patent discusses the need to interoperate across public blockchains, even building private and consortium decentralized ledger technologies, those blockchains. And also, and this is another important difference that I've come across through this patent, is the need for DTCC to manage rights dynamically through the notion of a hierarchy of delegated wallets. Now, you might have heard what is a crypto wallet. These are the actual holding of the private keys of individuals that own certain crypto assets, whether it's Bitcoin, Ethereum, Solana. They actually contain the private keys that enable users of crypto assets to manage the transfer and selling off of those crypto assets. This is a very important notion. What is a wallet? All the more reason why you ought to subscribe to my channel and dig deep into those videos, which are very important and very interesting for your education and insight in general. Now, coming back here, so the notion of managing rights dynamically is another driver for DTCC to have issued this patent. And also they argued a potential third driver is the notion of countering the emerging risk around quantum security and quantum computing threat that would impose to blockchains. So this is all important driver elements for DTCC to play into this TradeFi onto the blockchain without, as it says here, giving up that institutional control, which is very interesting. But it also has its own risks, which I like to cover now next. Okay, so I want to just dig deep into what this patent would mean in terms of the advantages and disadvantages this would pose to particularly those retail investors in digital assets. What would this mean to them? I'm not really concerned about institutional players out there because normally they would have to conform themselves into the TradeFi route of entry into this blockchain world. The patent produced by DTCC is more acting like a blockchain bridging system that introduces two important elements, one of which is to do with this hierarchical wallet. So you have two types of wallets. One is called at the root wallet level. Now this means that this will be ultimately controlled by DTCC or its affiliates, versus the delegated wallets, which will be assigned to users and institutions within the DTCC bridging blockchain. That is important. And the second element is the ability for DTCC at any moment in time and at their discretion around revoking access or reassigning delegated authority rights over the delegated wallets at any moment in time. So this would mean that if you were to purchase, let's say, Bitcoin through this DTCC bridging blockchain system, it would in effect means that you won't truly own the Bitcoin. You're going to be wholly reliant on the root authority, which is at the DTCC affiliate level, which means that at any moment in time of their choosing, they could either honor or withdraw your access to those purchased crypto assets on their blockchain. So in practice, this is not Bitcoin as Satoshi once envisioned. It's more like a wrapped or a proxy asset subject to gatekeeper discretion. Now, this is the ultimately what's going to end up happening once they build out this bridge blockchain system. You can actually appreciate there are going to be some major setbacks or even hesitancy from those crypto assets or digital asset investors out there, whether it's Bitcoin or indeed any other crypto asset. They may actually be wary about what's going on here. Is this going to be something similar to what they've once preached about introducing CBDCs, those central banking digital cryptocurrency? Remember about that? That was once a red flag. And I think the same would also apply with this DTCC patent. And this is all the more reason why I pulled this video, because I really want to bring out to the attention, particularly on the retail investors who need to be most concerned about this. The real risk for investors, particularly those retail investors of crypto and digital assets, and like I said, DTCC could indeed revoke access to your delegated wallet if compelled by regulation, political pressure, or even a policy change. So it could be done at a whim and at any moment in time and at their choosing. That is the number one risk. The next risk, as I said, your Bitcoin could be custodial. So think of holding your Bitcoins or even digital assets on any custodial crypto platforms out there, whether it's Binance, Crypto.com, Coinbase, of crypto assets and transactions operating on those centralized platforms. So this is going to be exactly the same route that DTCC will like to achieve, is to become a replica of a Coinbase, become a replica of Crypto.com, Binance and all the rest of it. And the last point I put in here is self-sovereignty will disappear, replaced by platform permissioning, similar to how your bank controls your fiat. So this is certainly going to be the case, right? So from a retail investor standpoint, this is the most alarming and red flag that we ought to light up our bulb in our mind. We're going to be moving away from that, what decentralized blockchain was always meant to be, permissionless, without intermediary, without excessive lead times for clearing and settling transactions on the blockchain, lowering transaction fees. So this is going to be the entirely opposite effect with what DTCC would like to achieve. So the self-sovereignty, the self-custody of your assets will disappear overnight through this DTCC bridged blockchain system. And lastly, I want to just give you a quick comparison around the self-custody of Bitcoin, let's say, or indeed any other digital asset, doesn't matter, versus this DTCC approach on onboarding Bitcoin or digital assets onto their bridged blockchain system. So let's look at each of these features in turn and see which ones will reign supreme from a retail investor perspective. The notion or the feature of true ownership under the self-custody arrangement, you control the private keys, not any centralized custodial, whether it's Binance, Crypto.com, and certainly not the case with this DTCC. This is going to be controlled via a delegated wallet that they will issue under this platform regime to institutions and users. Like I said before, that could be taken away in terms of rights to those delegated wallets under that platform, that centralized platform, at any time and at the discretion of a DTCC. So very, very wary about that. The next point around seizure resistant, of course, under self-custody arrangement, yes. So if you were to buy Bitcoin, if you were to buy Ethereum, Solana, XRP tokens under a self-custody arrangement, you're going to be guaranteeing yourself 100% from the prospect of seizuring your assets, because it's going to be held under a self-custody arrangement. Very different in the case of the DTCC assets world, where they can revoke by removing those privileges through their root wallet on your delegated wallet. So there's going to be this parent-child or this big brother-child behavior through the root wallet on the one hand, and the delegated wallets that they're going to issue under this platform to institutions and users. So if they revoke that, well, then you're going to be completely buggered in terms of managing the assets that you once purchased through that platform. Now, in terms of alignment, specifically with Bitcoin ethos, was built by the people for the people from the ground up rather than top down, which is how the majority of the financial instruments and assets in trade fight have been brought about. So in terms of that alignment with the Bitcoin ethos under the self-custody, that's going to be 100% maintained and aligned, but not so much the case with DTCC bridge platform, which is going to be under the auspices of TradeFi compliance regime and tokenization. In terms of counterparty risk, since you're going to be managing your private keys, since you're going to be managing your day-to-day running of your assets on your hardware wallet, let's say, under self-custody arrangement, well, of course, there isn't going to be any counterparty risk. Of course, the only thing you need to worry about is how you protect your private keys and how to do it in a confidential manner. It is a counterparty risk under a custodial type arrangement, whether it's Binance, Crypto.com, Coinbase, and certainly DTCC and those regulators, and amongst many other centralized institutions. They are the greatest counterparty risk that we'll ever face. Bank is another example of a counterparty risk. So it's clear. In terms of TradeFi integration, well, since you're going to be managing your tokens and your private keys under self-custody arrangement, you're not going to be concerned about integrating that to any of the traditional finance systems, which is totally the contrary with this DTCC bridge blockchain system. It's going to be completely integrated, fully interoperable, like I said, with other blockchains, whether it's private, public, or consortium type blockchains. That's going to be completely integrated and interoperable. So that's a concern there. And lastly, retail friendly in terms of the feature of being able to operate your keys and your cryptos in a retail friendly manner. Clearly, under self-custody arrangement, it's very, very empowering. And I use both Trezor and Ledger, which is a hardware wallet provider. It's very, very intuitive, very, very easy and user-friendly interface in order to manage the actual buying and selling of your cryptos under your hardware wallet regime very, very easily, right? Which is not going to be the case, unfortunately, with the DTCC bridge blockchain system, where it's going to be gate kept. So as a summary, really, if I were to sum up DTCC versus self-custody, well, clearly, if you use DTCC in order to invest in your Bitcoin, as it says here, your access and your rights could be revoked at any time at DTCC's discretion or via regulatory enforcement, which is not the case if you were to buy and self-custody Bitcoin or other digital assets using a cold storage or a non-custodial wallet. This painter cannot touch your coins. You are outside their system. This is the bottom line of assurance that I want to explain to you, that even despite this patent, and let's say it's going to be approved by the International Patent Organization, we're going to be safe as so long as we don't purchase any future digital asset tokens through this DTCC bridge blockchain system, and we keep it strictly within our own self-custody hardware wallet, then we should be fine. So the DTCC patent brings Wall Street to blockchain, but it's TradeFi dressed up in crypto clothing. While it may pump prices, as it says here, with institutional money, it doesn't deliver freedom, decentralization, or sovereignty. For that, retail investors need to ask yourselves this question. Do you want exposure to Bitcoin, or do you want to own Bitcoin? That is the subtle difference. It's very clear to me which side of the question I'm going to be in. I'm on the side of I want exposure to Bitcoin, but I want to own it. That's the difference. So if you enjoyed today's episode, please don't forget to hit the like button and to share the video to other colleagues and friends. And if you haven't done so already, please subscribe to my channel, as I regularly publish some interesting videos such as these, anything to do with Bitcoin, blockchain technology, and the future of finance. So till next time.